So my first guest here is Chris Maxey, Chief Market Strategist at Wellspire Advisors. Chris, great to have you on the show this morning. And what do you make of the markets, how they are setting up today amid this backdrop of re-escalation on trade?
Yeah, good morning. So I think a lot of the focus is what we've seen in these past couple of months on expectations. And the expectations are that trade tensions were beginning to ease or at least settle into a more favorable zone. What we're seeing is that that's now re-escalating. So you have this mismatch of what the expectations and the reality are. However, as you think about what you were just discussing there, with the government having been shut down right now, there's going to be a lot more importance on earnings and what we're beginning to see in terms of this earnings cycle that just started here recently. When we think about the earnings cycle, it's one, again, of optimism. There is a higher bar this quarter than there was last quarter. And we ultimately think that companies are going to be able to exceed that, which is ultimately going to be supportive for the markets. So right now, we do have a moment in a situation where there's an expectations and reality mismatch that's taking place around conversations like tariffs and trade and what's happening with respect to the U.S. and China. But we do think that as you look at earnings season, as we get further into earnings season, we're going to learn that companies are still excelling and doing quite well.
Okay, so companies able to navigate this environment. Chris, it sounds like based on your input there, but how do you anticipate the leaders from corporate America addressed unresolved factors like tariffs and the government shutdown when we hear from them on the earnings calls?
Yeah, in our opinion, what is going to happen is that as you think about how corporate leaders are going to resolve this, they're going to say, you know, when we went back 2 quarters ago or we went back 1 quarter ago, we didn't pass through any of the tariff costs. We didn't pass through any of those input costs that were being borne by us. What we think is going to happen as we look this quarter and what the message is going to be going forward is that now it's time to pass through the costs. We were able to stock inventory. We were able to eat that cost in our margins, but that's no longer going to be the case. And we've already seen that start to happen with regards to the producer price index, with the consumer price index, when that data was available. And now as you look towards earnings this quarter and next, it's very likely, in our opinion, that companies are going to begin to message, hey, it's time for us to pass through those costs. The consumer balance sheets are looking okay. Consumer credit quality is looking okay. We think that this is a moment when consumers are going to be able to absorb the higher cost, and that's not something that we're going to bear.
Interesting. So that would portend likely higher consumer inflation. We know that that figure has been running above the Fed's long-term 2% target back since 2022 at a time where jobs data, at least for the data of the months available, we're not getting that jobs data, at least from last month with the government shut down, but jobs growth certainly has slowed and actually dropped, contracted in some months that we've seen this year. How does that factor into the Fed's decision and the path forward on interest rates?
Yeah, so the Fed has been out with a number of different messages here recently, and when you think about what their path forward is, we have that rate cut that took place in September. We're very likely to get another one before the end of this year. And then as we pivot into next year, that remains an open question. Do labor markets weaken further from here? Do they begin to strengthen and stabilize? That's one of the areas that nobody knows just quite yet coming into the end of the year. So with regards to the Fed, I think part of what they're looking at is this delicate balance between labor and inflation markets. Inflation is likely to begin picking up here at the consumer level. It's already done that at the producer level in the last couple of months. That once we begin to get that data here later in October, going into November and December, assuming that's available, we're going to see that consumer price index begin to reaccelerate. But is it going to be enough to offset weakness in the labor market? You know, right now, we don't quite know. We wouldn't anticipate that labor markets are going to deteriorate markedly from here. It seems like this is a situation where hiring is not picking up and we don't have an increase in the number of layoffs. So at least from that lens and that vantage point, the labor market is going to be okay for the time being. It's that consumer price index that we don't quite know. We would anticipate that's going to pick up. It's going to reaccelerate. Is it going to be enough to offset that slowing growth trend that we've seen in labor markets? Probably not. So that still leaves open that door for a Fed cut in December, and then 2026 we'll reassess as we get closer to the end of the year.
Collectively, what does this mean for the path forward for stocks? We've seen choppiness return to the markets just for the past few days or so, most notably on the re-escalation of trade tensions between the U.S. and China.
Yeah, on the stock front, markets have done remarkably well since the April lows, and everyone has been talking about that. Everyone's been focused on that. But when you really look at what's going on, corporate earnings continue to exceed expectations, like we spoke about earlier. So second quarter, the bar was relatively low on all of the concerns that were out there. Companies came in above and beyond what was expected. Now, as often is the case, expectations begin to pick up little by little, and now can companies exceed that bar and that expectation? Well, even where we are right now, corporate earnings are coming in with a likely growth of around 8% year over year in this last quarter. And when you go look at what came out this morning just from the banking sector, we're already seeing that there are surprises to the upside. So yes, the expectations have increased, but the fundamentals are justifying that increase in expectations. That's ultimately going to be market supportive. So we haven't even heard from the biggest tech companies just yet. We're only now talking about the banking and financial sector, which all of those companies came out this morning with a very positive message. That likely flows through, based on all the deal making and IPO activity, to the rest of corporate America, and will continue to be to the upside.
Chris Maxey, Chief Market Strategist at WealthSpire Advisors. Chris, thank you.
Thank you.